The idea of continuous growth over time is powerful, particularly when it is positive, uninterrupted. And there's only a very small handful of places we can get it.
Let's think about where we're storing our money and why we're storing it. What better place to keep your money than inside of the policy? Once that money is in the policy, it's going to work for you.
My PUA goes into my policy and I borrow against it, and maybe it nets out to zero with the policy interest and the growth of my policy. True. But I get a dividend on that whole amount because that chunk of money in my policy is still spitting out the dialed in interest rate forever as long as this policy is in force.
When you're using infinite banking, you are in control of the entire equation. The key is that you're playing almost every character in the play.
All right, welcome back to Remnant Finance. What's going on, Brian? How was Christmas?
That was great, man. It was a lot of fun. Yeah, we're recording here on the 26th. So Christmas just ended. Merry Christmas. We didn't talk in person. We did text yesterday. But yeah, it was good. We just stayed home, which was the first time. We normally go to my in-laws, which is actually a lot of fun and really good. But for whatever reason, the kids were like, we just kind of want to do low key. So it was just us at home, spent the whole day together. It was awesome. I enjoyed it.
That's awesome. We're here in Coronado. I have my in-laws. They spend the winter out in Arizona to get out of the New Hampshire winter. So it's about a 5-6 hour drive from where they are to visit us. So half the year they're out here pretty frequently. And they came out for Christmas and it was great. My daughter's 3.5. So this is the first one where she kind of fully got into being excited about everything. And last year I was in Virginia. I was still on that punishment tour and I was able to be home for Christmas, but I had a red eye out that night. So it kind of just tarnished the whole day, just with that kind of looming over us that I was going to be flying out at night. So this one was really fun. Just seeing my daughter, she got a big girl bike and just really proud of that. It was a really good day.
It's fun when they're like in the zone.
Yeah, exactly.
Like my 10-year-old this year, she started questioning it last year and we kind of just kept playing with it because we also have another little one. And so this year she came to me and it was like she could have written like an 8-point paper. Like she presented all the evidence of why I don't think Santa's real. And I was just like, no, yeah, you're right. You're completely right. So I only have one in the zone now. 3 of them are out of the zone. So like that whole magical part of it is I can already see it slipping.
Yeah. And I don't know how, right. Yeah. My daughter's all about it, loves it. And I think it's so fun. I think it's just like, it was a great memory from childhood. And, get over the disappointment pretty quick. But I just feel like my daughter's too smart. Like, I just don't know how long it's going to last, but she is absolutely loving it right now. My wife crushed it. She actually got me a sword. It's right here. It's like a antique sword. She got this at an estate sale with a naval officer's hat. And so I had no idea. And it's old, sort of beat up. You can see, but it's got a cool wooden handle here. And man, I tell you what, when you pick up a sword, you just want to kill something. Like I was saying yesterday, like please IRS, please, all the riffraff we've got here down by the border here, man. You just want to. And we talked last week about when I was in college and we'd go kill hogs with pig stickers. I mean, this would be a monster pig sticker, but man, just holding a sword. And it's funny, I was actually looking at swords online. I would love to get a good sword. So it's just so cool to open up an actual sword for Christmas, and I need to figure out how to mount it back there somewhere. But it's just, man, I just love weapons. It's great.
You're getting ready for the next crusade, maybe.
Oh yeah, dude, they're coming. They're coming. We need a full-on Inquisition here. Anyways, hopefully we've turned off enough of our listenership that is not going to be aligned with us anyways. And so, we'll part ways here. And if you're still with us, we will continue to think and talk like this, but also to help with finances and answering questions about infinite banking. And particularly today, we want to address one that almost every client has when they first are approached with or come to grips with this concept. And there's probably a list of 8 or 10 questions that are without fail going to come up. And so we want to address one of them, which is, why would I use a policy loan when I have cash in the bank? And we're going to hit a few concepts. Some we've covered before, but we want to try to tie them together and that is that you finance everything you buy, that we're not trying to squeak out arbitrage in the interest rate here. We're not trying to make this short term optimized financial play. And then at the end of the day, it comes back to the value of control, or what we'll start referring to as financial potential energy. So, how does that question usually get phrased when it comes up with this?
I mean, you pretty much already hit it on the head. How it gets phrased is why would I take a policy loan? Why not just do this, or why not get a loan from the bank? But I want to talk about first, like one thing that Nelson Nash always said is that your money has to reside somewhere. So while I am guilty because I probably need another policy, and I have money sitting on the sidelines right now in a bank account ready to pay premiums in the spring, in the early spring. Why do you have money sitting in a bank account would be the first question. Once you have an understanding of this, I should say, these are the questions that are being asked as people learn infinite banking. But ultimately, as you gain a better understanding of this, is what's the best place to warehouse your wealth? And why would you leave cash sitting in a checking or savings account when you could have it in an optimized environment? I think I might already be hitting on like the next level
Mm-hmm.
of thinking through this, but that's something I am thinking about is as you progress through infinite banking and through the money movements we do in the order of operations, it's like, let's think about where we're storing our money and why we're storing it. So I probably hopped right over top of the meat of the question, but I still think some of our folks who've been listening for a while can dwell on that. Is what better place to keep your money than inside of the policy?
Yeah, and let's talk about what this actually looks like for those that are not fluently speaking infinite banking. We're making assumptions here that you may not be ready to make if you don't know exactly what we're talking about. So as an example, let's say, someone's considering, they understand the value of life insurance and protection. They get that they can use their policies, that yes, you do have some contractual rights, but let's say this person wants to do a $20,000 policy, put some of it towards base premium, some of it towards the paid up edition, which as a reminder is the way we kind of early fund the accessible cash value, because the base isn't going to get that for you. So the question would be, okay, well, if I'm going to put in money towards this policy and I want to do an investment, I want to, real estate, stock market, whatever, why would I not just take out a whole life policy, reduce that just to the base because I want the protection? But I'm like, what you're saying to do is put that money, the whole thing, into the paid up additions rider on top of that base premium. So pay, say, the full $20,000 into this policy, and then turn right back around and take out a policy loan and pay an interest rate to access the money that I previously just had sitting in my checking account. You're right. Money has to reside somewhere, Brian. But you're saying pull it out of my savings account where it's earning an interest rate and accessible, put it into a policy via paid up additions, then borrow that money, but not borrow it, borrow against it, and now take out a loan where I pay interest to the insurance company, and then take that money and go deploy it where I could have just gone straight there. Like, why am I adding this middleman step?
The middleman step that you're talking about of putting it into the policy in the form of premium and letting it start to grow is part of the long-term thinking that we want to teach with infinite banking. So once that money is in the policy, it's going to work for you. So it's now beginning the phase, even in day one, when you place it in that policy, it's now that premium has been captured. It's part of a contractual value. So that money is now going to start to earn the interest and the non-guaranteed dividends, but non-guaranteed to the point that, the companies we work with have been paying them some for almost 150 years perpetually, uninterrupted, forever. So if we're thinking short term, 100%, you could probably do better in the next 12 months, maybe even the next 2 or 3 years, by just using your cash and not paying interest. But what we have to think about is that money, let's just use 4%. That money is compounding and it never drops with the market and it never gets interrupted. We say that all the time, uninterrupted, but I think that word sort of just flows by sometimes without really thinking of the impact of the fact that in 30, 40, 50 years, what did that grow to because you didn't give up the opportunity for it to keep earning interest?
this explanation should happen without ever using a specific interest rate, because that's not what we're talking about here. However, we are going to do that because it helps you kind of put meat on the bones here. But this is a philosophical discussion of the control of capital. But people say, yeah, sure, that's philosophical issues are great, but at the same time, if I'm losing value, if I'm losing arbitrage by doing this, it still doesn't make sense. Like the fact that I'm losing money on arbitrage here based on what I could be doing does not trump the philosophical idea of having control and cutting out the banks, et cetera. So we could have this answer without ever mentioning a specific interest rate, but in general, we're going to basically say, and I'll add a little bit more to what the person who's asking this question is going to say is, okay, you're talking about compounding growth, guaranteed uninterrupted compounding growth. That sounds great. Sure, maybe I'm getting 4% guaranteed uninterrupted growth. And so, but if I'm paying 4% just to keep it even on my policy loan interest rate, it's a net wash. And so I'm getting no value from this. And I have the real estate, but like why would I do that for a net wash? Sure, under like the compounding growth is great, but if it's exactly reduced to zero by the interest rate that I'm paying, it's not a good talking point. So what would you say to that?
Well, I don't think it is ever absolutely reduced to zero.
Right.
Like, I think the time frame is important here. Like, in what time frame is it reduced to zero? And I
Right.
think that the only time it's ever reduced to zero is always in a short-term viewpoint. And I also think when you're giving up the opportunity by using that cash, the opportunity, that money to continue to grow, you're also giving up all of the other ancillary benefits of having it flow through this system. You're giving up more death benefit. You're giving up contractual protection. You're
Mm-hmm.
giving up everything we've talked about in our prior episodes
Yep.
to use the cash to try to maybe, even if it does get to zero. So even if it does just get to zero, what are all the perks of whole life insurance that you gain by flowing it through that system?
And a common thought is that when we're talking this way and we're talking about the numbers, we're grouping in the growth rate of the guaranteed growth of the cash value, what we call the internal rate of return, plus the dividends, and those net out. But no, what this conversation would be the same as far as my internal rate of growth on the policy versus my interest rate on the policy loan, whether it's a stock company or a mutual company. So the fact that we are getting dividends on top of that, those are not baked into the cake of these assumptions here. So again, it's not about these numbers. We're not trying to maximize and squeak out every percent of arbitrage, but these dividends that we're talking about are not part of this conversation. Those are additional, and we, again, not guaranteed. But when someone has this, and everyone starts with this challenge, everyone has this question of why would I do this? When we look at an illustration and we look down the road 30, 40 years from now, and we see these numbers, the number, even with the very standard assumptions we're going to make as far as the dividend, which is just going to be current year assumption moving forward, that's something that we have to do without putting any extra icing on the cake here. If I show you the illustration that we're talking about 30 years from now, everyone says those numbers are awesome. I don't understand how insurance can do that. When we talk through the fact that uninterrupted positive compounding growth over these decades, plus the dividends used to purchase more PUA as you increase the size of your policy by purchasing PUA, therefore increasing the death benefit, your pro rata share, et cetera, et cetera. So these dividends increase because we continue to apply them to grow the policy, right? Down the road, 30 years from now, everyone can get behind those numbers. Who would not want to put in $1 into a whole life policy and get $3 to $5 out in cash value growth? More than that eventually down the road, right? Everyone gets that when you're saying, hey, this is my savings vehicle. I'm not comparing it to an investment. In my savings vehicle, if I can put $1 in and get $3, $4, $5 out every year and growing when I hit my retirement age, that looks awesome. Well, how do we get there? What do we need in order to get to that point? We're laying the foundation now. The reason those policies keep growing, the reason those returns on your dollar in versus dollar out in 30 years are so big is because what we're doing right now in year one, the PUA that we're putting into the policy and letting it grow and mature over 30 years of guaranteed growth as it becomes cash value, those numbers need the time now to grow. And so if you can get there at year 30 and you understand it, you need to have the discipline in year one to understand that, hey, even if, like you said, there might be a scenario, and there probably is very likely a scenario where a 1 year time frame, it might be better to just put the money into real estate and check back in on December 31st and what your balance is now versus going this route. Yeah, you're probably going to win out on your high yield savings account directly into investment, by skipping the middleman rather than going through this policy first. Probably so in year one. Let's fast forward 30 years. You now have a paid off rental property, and you have many, 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 many times over what you've put in death benefit guaranteed to return to your family's economy. And you have accessible cash value that greatly exceeds what you've put in. Like all of these things, if you can get there in year 30 and you understand why year 30 you would like to be in that situation, you need to broaden your focus and scale past this 1 year, 2 year, 3 year time frame.
Yeah, but when I first started teaching this concept, when it first grabbed me, and I started teaching it a few years back, I often used an example, and we used cars, and you'll see this everywhere. If you go on YouTube and look at infinite banking, people talk about cars, and a lot of it is bad marketing, but there are some pretty solid numbers. I used a $30,000 car at the time, which was like, mid-level sedan, probably even a little bit more now. But if we used that example, and what I used to tell people, I'm not going to put the numbers up on screen, but I think we can easily talk through it. And my numbers are going to be within $30 of what the actual calculation is. I'm just going to round to the nearest thousand or the nearest hundred. And I'll just run through this with you, Hans, because I do want to actually put some, like you said, numbers help people think through it. And this is a 5-year example. So when people talk about arbitrage and you have bad arbitrage, you can actually show that it's not necessarily true if you interrupt the first step by making that a new first step, paying premium and getting it into a system. So we can look through almost any of these companies and show that the long-term internal rate of return growth on a policy, I don't even care if I back it down to 3%, but it's usually like 4 to 5, 4 to 6% tax-free growth internally year after year. So if I just use 4%, somewhere right in the middle or the lower end of that with most places, and I say to you, I'm a banker, pretend I'm a banker. Hans, you have $30,000 in your checking account at my bank. And you come to me and you're like, hey, I want to withdraw that $30,000. I'm going to go buy a car. The car loan is 5%. And I'm like, hold on a second. Rather than use the 30,000 in cash and buy the car, let's not do that. That's what you initially wanted to do. I'm sorry. And I say, no, how about this? Deposit your money into a CD in my bank. The CD is going to grow at 4% per year. We're going to exclude the taxes and everything that would be paid out of this, but it's going to grow at 4%. And then I'll just give you a car loan at 5% initially. If you didn't know anything about infinite banking and you knew nothing about this, would you do that? Hans 2016, if I told you, I'm going to pay you 4% and take a loan at 5%, what would you probably say?
I'd say that's negative arbitrage. I'm not going to do that.
You'd say it's negative arbitrage. Why would I do that? Exactly. And then I'd break out some numbers for you. And I'd say, okay, this is compounding growth, the 4% I'm going to give you. And it's uninterrupted for 5 years. I'm using a 60-month loan. So that 30,000, if I multiply that by 1.04, and I do that every year for 5 years, so it's 4% growth on top of the principal every year. At the end of 5 years, the amount of money you would have is $36,500. Not exactly, but it's within a couple bucks. The money you would have paid on the 5% loan, the 5% interest on the loan of $30,000, you're paying that on a decreasing balance. So that interest rate decreases if you did a steady, just normal amortized loan amount over 5 years. It's going to end up being $34,000. It's just shy of that. It's like 33,968 or something like that. I can't remember the exact dollar amount, but let's call it 34,000. So you didn't make any money on buying the car. That's the bad marketing that's all over YouTube and other podcasts and places. People will say you can make money buying cars. You didn't make money buying cars. You came out a little bit better by $2,500 because you let your money grow uninterrupted, compounding at 4%, even though you paid 5%. So you now have $36,500, and the car cost you $34,000 with interest. So you're now sitting at a higher principal of $2,500. And that's just in one 5-year loan. But what if you started doing that with everything? And that's with negative arbitrage. That's why like the people that focus on this short-term arbitrage sometimes aren't seeing like the mathematical principle of what uninterrupted compounding growth versus a decreasing balance that's charging
Mm-hmm.
interest is. And it can be better than that. That is just
Yeah.
using a simple example without any tax efficiencies or anything. So now you do that forever. If you kept doing that for all the money that you're flowing through. So if you did that for your kids' vehicles, if you did that for your house, if you did that for your investments, when we really start looking at amplifying wealth and using it for investments, but even just on purchases, if you just did the first thing of paying premium before you go do those things, long term, that's just 5 years for one $30,000 chunk. Imagine if you just kept doing that with everything you did.
Yeah. And go forward, fast forward to that 5 year mark. That policy is continuing to grow uninterrupted as if you never touched it, because you didn't. You collateralized it. You have a separate note outside of that cash value, but you never actually reduced your principal, and therefore what you're getting dividends on this whole amount on the 5 year mark. And so if you've been doing this for 5 years and you compare any, like you said, any one year, you might say that, yeah, I could be a percent more efficient at the end of by December 31st, 2025, a year from now. I could have a percent more in my pocket than by doing this route. But by year 5, you're getting dividends on this entire amount as if you never reduced it at all. And so we just have to think a little bit long term. And one concept that we want to bring this back to, because I know we've talked about this before, the fact that you finance everything you buy, not only in this episode, but in previous episodes. I think we've made the example as well. But you have to remember, and again, to get back to the comparison or the challenge that people make is, well, why would I not just put this money from my savings account directly into this real estate venture and skip this middleman? Well, remember that the multiplication effect of money is very important. And the fact that money can do more than one thing, copy and paste money, whatever you want to call it, the fact that we can have these dollars doing more than one job, and we talk about the idea of, like, imagine there were a little money printer, and I'm going to use, actually, on our blog, we have an article called You Finance Everything You Buy, where I walk through this and I give the example of two guys at the car dealership. One is named Rave Damsey, and he pays cash for everything he buys and feels morally superior for doing so. And the other one is your standard Joe Navy guy out, going to get a Corvette out the front gate of a base with his, reenlistment bonus, and he's going to take out a loan here. And so at first thought, you think, well, one is way more financially responsible than the other, but there's a third option here. And if you understand, when Rave Damsey goes in with this pile of cash that he's so arrogant about only spending, that is a one-way transfer of him to the dealership, and he can never use that again. Okay, you didn't incur any interest. Sure, that's great. However, that money can never earn interest for you ever again either. And so if you have, let's say, 4% as your high yield savings account, and the example that I used was, imagine you just have this little black box and it's just a little printer, and you can dial the rate on that printer to whatever you can make with that money, and it spits out that rate of return for you for whoever's holding the box. I don't have a black box in front of me. I'm going to use the cash flow sword, right? Whoever holds this sword, let's say it's a $30,000 sword, and right now interest rates are 4%. I can dial this to 4%. Whoever has the cash flow sword here is going to get that rate of return. And so if I go to the dealership and I want a $30,000 car, and I say, hey, I've got the cash flow sword, I am going to feel superior to Joe Navy over here because I'm not going to get in debt to you. Here is the cash flow sword. Here's my $30,000. And the dealership says, thank you, because now we have the cash flow sword, which is spitting out 10%. And what they can do is they know how to dial up that return, and they're going to loan this sword right back out to Joe Navy, except not actually. They're going to collateralize it. Like the financial physics at play here, when you understand that when you give up cash to somebody else, it's a one-way exchange, and you are giving them the right to enjoy and earn on that cash, and you lose it forever. So yes, you have a car, but you have no cash. You no longer have the cash flow sword. That concept is something that applies as well in this conversation when we're talking about, what if I just move it from my high yield savings account to my rental property, to the real estate investment, to the market, whatever I want to do with it. In that case, you are at least acquiring a nominally cash flowing asset, hopefully, but you again have given up use of that cash forever. And so my PUA goes into my policy and I borrow against it, and maybe it nets out to zero with the policy interest and the growth of my policy. True. But I get a dividend on that whole amount because that cash flow sword, that chunk of money in my policy is still spitting out the dialed in interest rate perpetually forever as long as this policy is in force. And so I'm getting the return from my investment. I get to borrow against this as I pay down this loan. And so it's too short-sighted to simply say that if this nets out to zero, it doesn't make sense because and again, another article on our blog of how to use a policy loan, I walk through exactly what I'm doing. And every time I pay down a policy loan, I'm freeing up that cash value to borrow against. I'm closing on my third property right now, which will be my fourth real estate investment out of my policy. And in doing so, my dividends have never decreased. The dividend rate that I've received has been applied to the entire amount that I have this whole time, even though if you look at my cash value as a bar, over time, the amount available to borrow against has gone up and down as I've taken out a loan and repaid it and taken out a loan and repaid it, right? That's been changing this whole time.
Just like a line of credit.
Yeah, exactly. That's been happening in the background, and that has its own numbers, internal rate of return, interest rate. Like you could make those arbitrage numbers there, but what's happening the whole time is that this entire amount's getting my dividend and I'm getting this external return from the real estate. And so you just got to think a little bit deeper than just A is bigger than B, so therefore A is better. And by getting a little bit more interest rate in year one, it's short-term thinking, and it's not going to get you there.
Yeah, and you sort of touched on something that I'm just going to do a really short elaboration on it from my example of the CD, the loan, buying the car. If you did that exact scenario, Hans, who's in control of the entire equation?
The bank or the lender in that case.
Yeah, so in that case, the lender was. So they gave you a CD and they determined the rate, right? And then you have the government involved too, because every year you're going to have to pay some taxes on the growth of that.
Mm-hmm.
Who was in charge of the repayment schedule?
The lender.
The lender. What happens, even though you have money collateralized in their CD, what happens if you still didn't make a payment on that loan?
Yeah, they can repossess.
They can repossess all the way down to the car being valued at, or, to the last $100 of the loan, even whenever that's like full value of the car. So they could repossess it from the beginning to the end at any point in time. And they're not going to do you any favors. As a matter of fact, they'd rather repossess it in the last month than the first month.
Yep.
Because they can sell it and make a lot more money that way. Just same thing with a home. So when you're using infinite banking, you are in control of the entire equation. You are the depositor. You might not be in control of the dividend scale. That's going to be part of the greater economy, but you have your money in the environment where that's still working to your favor. Yeah, that's the gravy on top, but you are in control of the loan repayment as well. It is an unstructured loan because it's fully collateralized by your policy values. So the insurance company is going to loan you at whatever rate is determined at that point, fully collateralized by either your cash value or the policy values or the death benefit in the event you die, so they can never lose. Thus, the repayment schedule is on you. If you went and bought that car via a policy loan instead of the bank loan, you get the note immediately. You basically have paid cash for the car. You own it. The title is sitting in your safe or wherever you keep your title. If something happens, something big happens and you decide, I'm going to stall repayments for 3 months, cool. You're going to pay a little bit more interest, but you were in control of that. You own the car. Nobody's going to come take the car from you. So the key is that you're playing almost every character in the play, in the financial play.
Yeah, and it's going to look the same. You're sitting down at the in the little cubicle next door as Rave Damsey, but you walk out with your sword. You also hand a pile of cash to the dealer in the form of the loan you received from the company. So the dealer is going to collect his pile of cash from each of you, but you walk out, your sword still in your sheath there. He's left his cash flow sword on the table.
And so don't forget what Rave Damsey's doing at that point too. He walks out of that dealership, and what's he start doing with his cash? Like the new cash flowing into his life. He's like, well, 5, 6, 7, 8 years from now, I'm probably going to need another car. So he just starts saving in a checking account. Now, instead of you putting in a checking account, you're just making a loan repayment where you immediately have access to that money. Behaviorally, you guys are doing almost the same thing. You're just doing it in a much more efficient manner that benefits you and your family long term.
Yeah, and if you need to do that mindset, that paradigm, that strategy, and who that advice is good for is people that cannot maintain a positive cash flow environment in their personal financial economy. Like if your spending habits require you to take that tactic, if you're not at the point financially with your financial literacy and you're just with your practice of how you manage your personal economy, that's not inherently bad advice for a lot of people who need that. But the way that it's presented as if this is the only responsible way to do it, like you're getting advice for the sub average financial acumen, and it's promulgated as if this is what this is like the bar. And no, like once you get to zero, you should not be acting this way, because this is like get out of debt mentality, which people need to do.
And he's great for that. And I hate to always feel like I'm picking on the dude who we're obviously talking about, because he really serves a lot of people well
Absolutely.
who need that advice. Like, it helps thousands and thousands and hundreds of thousands of people probably get to a place they wouldn't have been able to get to with their current behavior by shifting to what he teaches. But at a certain point, is it now the most efficient way? It's a great way to get people out of a hole into zero, I think. And then I think there's much better ways to create wealth from there.
Yeah, and if we go back to the real estate example, the car buying is pretty easy to explain, because we're not introducing any additional cash flow considerations. It's literally just you have your little black box printer, or in my case today, the cash flow sword. Like it's easy to take that metaphor and understand why handing someone an envelope with $30,000 for a car can remove any future use for you of that cash. Like we can understand that, but now we're adding an extra element of investing and getting a return on this. And so there is this extra dynamic here. But the cool thing is the chunk, so if you were to fund in a rental property with a policy loan instead of with the mortgage, just like the car, nobody else has a claim on that car. You've paid off that note in full, as far as the person who would otherwise have the ability to repossess or actually cares about or foreclose, right? And so if my rental properties go under, or if I stop making policy loan repayments, it's not like the bank is asking me, hey, like, where's our payment? Otherwise, we're going to take your house from you and foreclose it. You can sever that dependence, and that comes back to control again. Which, can you put a dollar percentage amount on the value, on what control is worth in that equation, where no bank, no lender, no financing company has a claim to pull that property away from you if you don't meet their terms? What percentage is that worth in this equation? I don't know. To me, I would take a negative arbitrage of 1% in the short term, going back to our previous example, to know that I'm in control of the repayment. And if I repay it, again, we always advocate repay your policy loans, Nelson Nash style, like pay back more than you would pay the dealership, more than you would pay the mortgage company, because you're saying otherwise that you value their capital more than yours. So we advocate for that. But the fact that I can, and no one's going to come take the car, no one's going to foreclose the house, that is worth to me losing this arbitrage in year one, if that's how you actually look at it. But again, we're trying to get you from starting with that level of trying to get a little too granular on the short-term numbers, to seeing the big picture and the value of control. That's our overall mission here. And that's most of what we talk about is changing financial paradigms. And so we understand coming into this with this mindset, because that's how we're taught, and that's how we're trained to think about. Not taught is not the right word. That's how we are marketed to think about financial decisions. But we do not think that is the optimal way to think about it, because it does not serve your family first. It serves the bank's interest first, the way that we are propagandized to do it.
Yeah, it absolutely does. And I actually want to, because I've just had that question recently. I think it's a good follow up to our general discussion that I think is coming to a close. But I just answered this question probably twice in the last 2 weeks. Is, if you read Becoming Your Own Banker, and everybody should read that. If you haven't read it, get it, read it. Go to our website. You can click right there to get a direct link to buy it. Read that book. And in it, he talks about paying additional interest. And a lot of people ask that question, and they're like, why would I pay additional interest? And I just want to talk real briefly about what the idea behind that is typically, historically, not always, not even always right now, and definitely not in the last 15 years with all the Federal Reserve Bank manipulation of the interest rates. This arbitrage was upside down. But historically, if we go back 100, 200 years and we're back in this environment, you can access money via your policy loans, typically at a lower interest rate than the market. Like if you go buy a brand new car right now, I think market loans are between 7 and 9. I haven't looked in a while. It's been a couple months, but 7 to even to 10% for a new car. And you might be able to access money via your policy loan 5-6%. So people say like, what's this paying of extra interest? Well, when we look at that historical relationship on the arbitrage, you have access to money, let's just say at 5% via policy loan, but Wells Fargo is going to charge you 8%. So the idea behind paying extra interest that Hans just mentioned is that, do you value your money at a lower rate than you would value Wells Fargo? Because before you learned this new paradigm, you would have gone to Wells Fargo. They were in control of everything, and you would have just accepted, like, I guess, we need a new car, and this is what the rates are. It's the best we can do. We have to pay 8% on their money. Their money is worth 8% to me. Well, now that you have access elsewhere, like, is their money more valuable than your own money? Or you have access to it at 5%. But why isn't your money worth 8%? So the idea there is to pay at least the same as you would have paid the market at a minimum, if not more. So value your money at least equal to what the market costs. So that now repay your loan, let's say at 8% instead of 5. One of two things can happen there. You can use that extra, let's call it 3% interest if you did a little calculation, and buy more paid up additions to expand your system, expand your policy, and get more money working for your family system that you would have given to Wells Fargo. Or let's say it's a 60-month loan again, you're going to pay it off early. I don't know, let's call it the 57 months. But if that was at Wells Fargo, you would have had to pay all 60 months. So Nelson taught us, continue paying for 3 more months, even though your loan's paid off, but use that loan repayment to buy more paid up addition. So 3 months of paid up additions that buys more insurance, gives you more cash value, expands your system, and gets more and more money working for you, a higher volume. So that's the idea of what Hans said about paying yourself more interest. I like to go even above what the market calls, because I think my money's more valuable than the market, but that is the minimum that you should be thinking about.
Yeah, for sure. Yeah, I actually had that question earlier this week, and it's a common kind of misunderstanding, I guess, because people just think he's talking about how do you pay it early? Like, what do you do once you make that last payment? Does it switch to where, at the 57-month mark, you've paid it off and now you're just paying interest to yourself? No, it assumes that you have room into your PUA rider to put that money, and it's just saying put the same volume, total amount of money in, but at a certain point, once you pay it off, because again, all these are principal only payments when you're paying the loan, which is a great extra little benefit there as far as the value of a policy loan versus all other lending. But once you hit that point, put it into the PUA rider.
And that's one of the reasons that we choose, the companies we choose to write with have very flexible paid up addition riders. You can make those payments at any time of the year up to a certain ceiling, but we like that flexibility. Some companies don't offer that. You have to pay it all one fell swoop on the first point of the year. And while those could be good companies, the companies we choose are very flexible to allow you to take advantage of some of those strategies.
Yep. Bringing back to the idea of thinking long term. Just an example that we've all heard, and I'll wrap up my thoughts with this. We've all heard about the penny a day for 30 days, right? Every day, if I give you a penny on day 1 and I double it every single day, how much money will you have at the end? You can either add those together as you get it, like you're getting a double that amount each time. But even if you just take it as the amount that I have in my bank account will double once a day, starting at 1 penny, how much do I have at the end of 30 days? And the amount is almost $5.4 million, right? I'm going to tie this back to when I said earlier that when people look at the 30-year mark of their policy illustration, everyone can get on board with that. I've never met anyone who's like, I don't want that. I don't want that down the road, because that is a great place to be when I'm 65 in my savings vehicle, getting a 5x return on every dollar that I put in, tax-free growth, et cetera, or technically tax deferred. But in the same way, if you were to look at the line, if you look at a graph of this, and I'm looking at the chart right now, day 1 through 30, 1 penny, next day 2 pennies, 4 pennies, 8 pennies, 16, 32, right? We don't even hit $1 until day 8. We don't break $100 until day 15. We're halfway through the month, and our bank account is only at $100 or 163, but we haven't gotten to triple-digit dollars until halfway through the month. We don't hit $1 million until day 28. And so if you think about that, if you were to cut out 3 days from that growth chart, The last 3 days, instead of $5.4 million, you have $670,000, right? You need that full time. Einstein did not say that compound interest is the eighth wonder of the world. He definitively did not make that quote. It can be argued that he said that compound numbers are the eighth wonder of the world. It doesn't really even make sense. I don't know why he would say that. And I think that now that it's becoming clear that most of his material was stolen, it's probably just something by the marketing industry, the financial marketing industry to get us on board with another concept. But that idea, the power of compound interest, like we always say, it is very powerful when it's uninterrupted. But if you think about the fact that on that chart, the last 3 days of the month is where you make your money. Let's just say you decided to start on day 4 instead. And this gets back to people saying, wanting to wait on a policy. Maybe I'll wait a little bit until I get a stronger cash position, or, and everyone says, I wish I had started this sooner. Well, if you're on day 4, i.e. 4 years into it, you've been hearing about this and you've waited 4 years. And now you're like, all right, maybe I'll pull the trigger. Well, let's just look at this chart here. You're on 8 cents on that day 4. Well, you're not going to get to day 30 with $5.4 million. You're going to get to day 30, 3 days, 3 days shy of that. So you're at that 600. You need another 3 years, right? The time in compounding is invaluable and uninterrupted. And so this is such a powerful concept, but it's almost exclusively misapplied to stock market investing, which is not possible with this. We've said before, you cannot have compound interest in the stock market. It just doesn't. You don't have interest in the stock market, but the idea of continuous growth over time is powerful, but particularly when it is positive, uninterrupted. And there's only a very small handful of places we can get it. And so if you're starting on day 4 of your monthly chart, or year 4 of your journey and figuring out if you want to do IBC, that time now is very valuable. And so, yeah, if we're having that conversation with someone who says, why would I not just put money in? Because look, day 1, I have 1 penny in my penny a day for 30 days chart. Year 1, I have $2,000 more than I would if I had done, like if we're making an analogy here, well, yeah, sure. Maybe you only have 1 penny, 2 pennies, 4 pennies, 8 pennies early on. Do you want to get to day 30 at $4.4 million? I do. 5.4, right? I want to get there. And so, yeah, I am going to sacrifice, maybe not actually when you understand it, but even if we assume that, maybe you have a percent arbitrage over me on days 1, 2, and 3 on this chart. Instead of 1, 2, and 4 pennies, you might have 3, 6, and 9 pennies. That's great. But I'm looking at day 30 and I'm looking at this guaranteed positive compounding. That's why I want my money going to this PUA rider first. And then I will do what I will do with it, even if it's a wash with interest rate, et cetera.
Yeah, that's a good cap.
Cool.
Nothing to add.
All right.
Something we probably should ask a little more and don't ask, but if you enjoy this content we're putting out, we'll ask you to subscribe, to share it, please, with people who you think could take some value from it or could learn from it. Please share the podcast, the YouTube episodes, whatever medium you look at this on or listen to it on. Like, share, subscribe.
Yeah.
We got a new year coming, so let's think about some goals and some positive changes you can bring in 2025. I'm not a big fan of the New Year's resolutions per se, but there's nothing wrong with goal setting at any point. And if this is something that you're thinking about doing, the old proverb that best time to plant a tree was 20 years ago, which goes back to 4 days ago, like Hans just said. Second best time is now. It's still better to start than to keep delaying. So let's make 2025 the year.
Yep. Pull up that penny a day chart over 30 days and see where you are from when you first heard about this concept to, how many years are you into it of exploring whether or not you want to pull the trigger, and just look at what's happening on the back end. It's harder to see day 30 when you're on day 2, but if you can see it all at once, which an illustration can help you do that, you can see why you want to be there down the road, and you get there down the road by doing it now. So
thanks everybody. We appreciate you.
All right.
Happy New Year by the time you hear this.
All right. Cheers.
Yeah.